now miraculously changes into an improvement. So be careful of not only what you're doing, but when you're doing it, because that can certainly change the character of it. So ask your specialty purpose accountant to advise you on that as you're going through the strategy of what you're going to do. The next thing we get a lot of queries on is, you know, I didn't expect I'd be paying tax this year because I sold the property last year. So when you're looking at a property, you've got to start understanding how am I going to be taxed? And will it be taxed at my normal tax rates, or is it going to be a capital gain that I can apply the 50% capital gains tax discount to? So that question starts when you buy. So what your intention is at the time of purchase. So I know I've got the word sale there. I've got a prize for people who would have picked that up. But it's the intention at the time of purchase. So if your intention when you buy is to sell, then even if you sell it 5 years later, it would be taxed at your marginal tax rates. If your intention at the time of buying was to keep it, then it's a capital gain. So if you held it more than 12 months, then it would be subject to the 50% capital gains tax discount. But if you sold it before 12 months, it's still a capital gain if your intention when you bought was to keep it, but you don't get the 50% capital gain. You just pay tax at your marginal tax rates. But that's not all bad news, because if you've actually got some capital losses somewhere, you know, maybe from share trading or whatever, or another property sale, you can actually use that capital gain on that sale of the property to absorb your capital losses. So very critical to understand that. So when you bought the property, what your intention is, that's what will dictate whether it's normal income or whether it's a capital gain.
And Ken, the critical test is that 12-month.
Correct.
12-month test there.
Yeah. So if your intention was when you bought to keep, then it's capital. If you've kept it 12 months, you get the 50% discount. If you've sold it prior to 12 months, you don't get the 50% discount. The other thing that traps a lot of people is, a common trap is people think the sale has occurred when settlements occurred. So when you've got your money or when you've had to pay your money. But the trigger point is the date of the contract. So a lot of people call that contract exchange, and for different states they use slightly different terminology. But it's that date that you committed to purchasing that property, which is the contract date. So your 12 months would start from that date and also finish, if you're selling, at the date that you sign the next contract to sell. So very critical to understand your intent at the time of purchase, and very critical to understand the timing. The timing starts from the date of contract, not from the date of sale. And just be very careful if you've kept it one day more than 12 months, because that's red rag to the ATO to make sure that you haven't contrived the sale to be one day later. So just be careful with those couple of points.
Can I jump in there with a question, Ken? From
yes, please.
Jody? Yeah, Jody's got a question. What happens if your intention was to keep, but then circumstances changes, you decided to subdivide, perhaps, and build 2 units, keep one, sell one? How does is it really the timing there that matters, or how does the